First of all, thanks for coming out. It was a really great turnout, really incredible how strong the Ethereum community has gotten. I think we should just continue to support each other and we'll see this thing grow to really what it can be. So the topic today is why order books on the blockchain are hard. I was a high-frequency trader for 7 years and I've traded on 150 different exchanges globally. Today we get to talk about two of my favorite things, trading and blockchain. I'm excited to bring those two together. So how many of you guys would consider yourself a trader? Not so many? Trading tokens? Yeah. How many of you would consider yourself like a blockchain head? We have a lot of people just learning about this stuff. Cool. All right, so what's an order book? Let's start with that. Essentially, it's to facilitate the exchange of assets. You submit your bids and your offers, and there's a matching algorithm that matches your bids and offers. And with this matching algorithm, you can decide how matching works, how priority works, and this is all coded into your matching algorithm. And another characteristic of it is that it's public. So here we show the topology of a centralized exchange. So we have our maker, our order book, and our taker, and these nodes can be any maker or any taker. And it happens in the workflow that the maker submits the order, the taker sees that order and decides to execute against it, and the order book makes a decision whether the execution should happen or not. So what do traders want? All right, if you're a trader, what do you want out of an exchange? You want low friction. So what does low friction mean? Low friction is low fees. It's security, that the exchanges get hacked and all your coins are gone. It's trust. You need to trust the exchange. And low latency. You want your transactions to happen as quickly as possible. You want fluidity. Fluidity is this beautiful thing. That means that you have orders submitted, processed, canceled seamlessly. You have a lot of executions. And you want fairness. You want the exchange to be fair. This is actual footage of me as a high-frequency trader. Lost quite a bit of weight since then. Okay, so how do we trade today? So we have the classic world. I'm calling it the classic world. Splitting these up. Classic world, crypto world. So the classic world, we have NASDAQ and CME are both considered exchanges, probably premier exchanges. And those are order book architecture. And then you have over-the-counter trading, which is more like the bond markets, happens mostly over-the-counter. And then you have the crypto world, which is Bitcoin and now Ethereum growing like crazy. You have these exchanges, these centralized exchanges. Coinbase, Polo, Kraken, those are all order book technologies. And you have this kind of new one called Shapeshift, which is more of a peer-to-peer matching. There's this shift happening towards decentralization, which we should kind of touch on. And centralized is more the traditional approach, where you have centralized parties where you can execute against. And in order to do transactions on a centralized exchange, you have to trust that the exchange is secure, ethical, and diligent. You want it to be secure so that you don't get hacked. You want it to be ethical so that they're not front-running your orders or anything like that. You obviously want them to be diligent. You want their code to be really good. Now the concept of decentralization is introduced through the blockchain. You can essentially, through the blockchain, you can have transactions without requiring trust, and you have no third parties that are verifying those transactions for you. So this is extremely powerful. Just talk quickly about the world of Ethereum. So blockchain, classically will store the state of the world. It'll tell you what is the state of the network. You have the concept of on-chain and off-chain. And on-chain is anything that happens and is stored on the blockchain. Off-chain is anything that's not happening on the blockchain. And then Ethereum also introduced the concept of smart contracts. Well, didn't introduce the concept of smart contracts, but allowed for smart contracts to be executed on the blockchain. And what is a smart contract? It can be anything. It can be any piece of code that you want to store on the network. And for example, the tokens that are happening right now, those are essentially smart contracts. Smart contracts itself are mined onto the blockchain. And in order to mine a transaction onto the blockchain, you have to pay gas. And this is very powerful because you can have all these Ethereum allows for all these new types of transactions to happen. Here is an example of a blockchain network. Obviously the nodes, there could be many more, many less. Anyone can join this network. The communication between the nodes isn't quite exact, but this is just an example of what could be a blockchain network. Okay, so when you deploy a smart contract onto the blockchain, what happens? It first needs to be disseminated to the network as a pending transaction, and then it gets mined, and once it's mined, it disseminated to the network. So this could the smart contract is pointed to a miner. It could be pointed to any miner there. Okay, so now we were saying before that smart contracts can be anything that you want them to be. So you can make them actually an order book itself. So you can store all the bids and asks. You can have people entering orders, canceling orders, executing orders. You can have all that logic happening actually in a smart contract. And the matching algorithm itself can happen in a smart contract. So essentially, there's a possibility right now, and you're seeing a few different implementations of this, where an entire exchange is being run on the blockchain. I use the dotted line to indicate kind of a cloud structure. But this is, kind of getting at what an on-chain order book would look like, what the topology would look like. You have the makers submitting an order, it gets mined, it gets disseminated to the network. You have a taker trying to execute against that order, and likewise, that's getting disseminated to the network. Okay, back to our what do traders want. So now we have a design for what an order book on the blockchain could look like. What do traders want? Let's go back to this. We have order books on the blockchain, and first we should talk about it's open source code that's being deployed. And so in theory, there would be no fees. I would argue that if there are fees, then there will be a solution that just takes the code and reduces the fees to zero. You don't need to have an account, so you can basically execute with counterparties without having any risk that the exchange gets hacked. And the last point that happens right away is that the code is verifiable. You'll have a lot of people looking at this open source code, and it's running on the blockchain. So this is increasing the trust that people would have in this blockchain-based order book. So back to what do traders want? So now we have low fees, we have security, and we have trust through a blockchain-based exchange. Okay, now let's consider latency. So as some of you probably know, NASDAQ knows the state of their network in less than 40 microseconds. So that's 40 millionths of a second. It's extremely fast, extremely efficient. The Ethereum network has approximately 10-second block times. And with Casper, they're trying to get down to about a second. We're still out by 6 orders of magnitude as far as speed, as far as getting to what a centralized network, a really efficient centralized network can get to. And also just, to talk about consensus by definition takes time. So I don't know if we'll ever be able to get down to something like 40 microseconds, especially because you have to communicate the information between the nodes globally. Okay, so we're back to our what do traders want, and we've lost low latency. Not so bad. Keep trying. So, okay, so scalability. So when orders are submitted to these smart contracts, they need to be mined, and same with cancels. And so this essentially means that your orders and your cancels are going to be costing gas. And additionally, the matching algorithm itself, as you start to add more and more orders to the book, the matching algorithm gets more and more expensive. Through those two, you're gonna just be paying more fees. That kind of brings us to a question mark on fees. Are you going to get lower fees while trading on this on-chain order book. The next point I'm calling automation. Basically, when you charge for orders and cancels, you make it a lot harder for market makers to place quotes on your exchange. Also, in an on-chain order book, you can't have any leverage because you don't have an account. You don't have a brokerage backing your orders. So you have to fully pay for the entire value of your order every time you submit an order. And this kind of will hurt the fluidity of your exchange. So we've lost fluidity. Privacy. So this is kind of a subtle one, but miners essentially can see your orders before anyone else, before they post it as a pending order or or before they mine it. And so this kind of creates a weird situation where if a big order comes on the book, the miner can sniff it and front run it. So you probably need some way to encrypt the order itself in order to accomplish something more fair. But we've lost fairness. And this is kind of the more subtle one that I think it's related to privacy as well. But basically, because of the blockchain network, anyone can join the network, and the network is communicating information off of whatever network infrastructure that's on the blockchain network. It's not guaranteed to be fast. So you can have really sophisticated participants sitting in different parts of the world and communicating information to each other faster than the blockchain network can communicate. And so, what I would fear this would cause is a dichotomy where certain participants have a big advantage over other participants. And so this kind of hurts fairness, but I think it also hurts trust. So
The advantage, how do they have that fast private network within the blockchain?
it's not within the blockchain, but what they can do is, like, let's say there's a node with low hash power, and there's a pending transaction on that node, and the sophisticated participant knows where the node with the high hash power is. They can communicate the information on their network faster than the blockchain network can.
But this competitive edge or fairness, how is that, saying that it's going to cause this dichotomy where people have a competitive edge, how is that different from when you were high frequency trading compared to an individual investor? Like, that's the same thing, right?
Well, in a high frequency trading setting, I think you're talking about multiple exchanges. In this case, that's happening on a single exchange. So you're introducing a dichotomy on your exchange itself, rather than between exchanges, I think is the way that you're describing it.
So if I can just clarify, so the Orange network is their own private network, so they've
Correct.
left the block, okay.
Correct.
Can you repeat that one more time?
Yeah. So this is an exchange itself, right?
Yeah, within the exchange itself. But within an exchange itself, an institutional investor already has that advantage over the individual investor. And they are the more sophisticated participants.
Yeah, but this is a way that you're creating. You're basically introducing a way so that sophisticated participants could have an advantage, and I'm saying that that's a bad idea. Right? I'm not saying the current state of the world is perfect, but I'm saying that if you start to see these distributed order books, you're just introducing an opportunity for people to, take advantage of the system.
Doesn't like if you have TD or Ameritrade, they'll route it pretty efficiently.
Right.
The high frequency traders are probably the exception.
Yeah. Yeah, so yeah, TD will route it for you, but in this case, it's probably pretty hard to figure out your routing algorithm. Yeah.
I understand answering him is probably more efficient right now.
Is there an effect either making it more dichotomous between sophisticated and unsophisticated or less dichotomous based on whether the latency is higher or lower? I'm just trying to process just how those interact.
Yeah, so I think that
Wouldn't higher latency lead to just less of a gap between the two?
agreed. Yeah, so once you start to get to where the block times are really small, then this becomes more important because you can race to other nodes and get mined before that node got mined. But yeah, that's correct.
Assuming that you're not a miner, right? The problem is that the miners always have an intrinsic advantage because they have the opportunity to actually order the transactions. Not every block, but so the by even with a high latency, you're going to get better gossip. So it's more likely that all the miners are going to have the same transactions. But the miners always have the opportunity to change the order of the transactions, and if they win, they're going to order those. Yeah, well, because they're actually deciding what the final canonical ordering is. So they can do that to their advantage. And that does actually relate to this. I don't want to hijack your talk, but if you're a civil miner, right? If you do like an Eclipse attack or maybe I should translate. So
As Rick Dudley is building something really cool, by the way.
yeah, so I've been working on this stuff for a long time. You can, so actually if you actually look at this graph, this node here that's not, some of the nodes have more lines going to them than others. They're more highly connected on the graph. As a miner, if you make yourself more highly connected and you have enough hash power, you will statistically be able to order the transactions more often than the other participants.
Closer to the data set, basically.
I'm sorry, what was
You
that?
get closer to the data set.
Well, you are deciding the ordering.
Okay.
So that's the issue. The miners are deciding the ordering, and if you have a relationship with the miners, you get an advantage in the ordering.
Is there a fail-safe to avoid market manipulation where they choose a certain order for, and say somebody.
Don't put your order book on the blockchain. That's the solution to that problem.
I'm sorry, are you saying that a miner can identify, like, they would have to know who is behind the transaction?
Of course, it's trivial to find that out. They know. They see who owns every transaction that's submitted, of course. I mean, they're signed transactions, that's the whole point. They're signed transactions from a network on the internet. So between those two things, you can have a pretty high reliability of who it is. You can't use Tor if you're a competitive trader. So we know what your network topography is, and we can identify you that way.
Do we have any kind of makeup of like what the mining community looks like for Ethereum? Is it like more commercial, like retail, like one person sitting in
I
the
couldn't,
garage?
I don't have a good sense of that. Anyone here?
I think it's moderately centralized. I mean, it's probably less centralized than Bitcoin. Yeah, definitely less centralized than Bitcoin, but it's not the pure egalitarian kumbaya daisy flower chains running around that you might want.
Will sharding solve this?
Yes and no, right? If you have your order book on the, so like, it depends on which sharding model you use. So if you look at like Casper 1.0, no, it's not going to help you. If you look at Casper like 2.0 or Cosmos, Cosmos has the opportunity to help you right out of the box. I work on both projects, so yeah. So if you do Cosmos style sharding, then yes, that could potentially help with some of these topography issues. And Casper has it like in the roadmap, but it's not a priority for Vitalik to address this particular problem, or it is actually a priority for Cosmos to address this particular problem.
Cool. So yeah, so this is what we have with blockchain-based exchange. And I think that when you're designing an exchange, I think that there's certain things you should think about always. Number one is latency. Number two is scalability. Number three is privacy. And number four is whether your architecture is introducing any race conditions. So upcoming work that's exciting for this type of solution, I think it'll get us closer. The first is, Casper sharding will help a lot with scalability and speed. Zero knowledge proofs allow for privacy, and I think if you have privacy, you can mitigate a lot of these race conditions, especially with the miner being able to figure out what you're doing. The other kind of category of exciting work that's coming up is state channels, which I'll kind of put in the same boat as side chains or private chains. Basically, it's you store the state of the network, you do a bunch of off-chain transactions, and then you communicate those back to the network. And this has a lot of promise in the scalability and privacy sides. I think that anything off-chain does require trust in the platform, trust in your code. So I think that those state channel solutions, I think they'll take a little bit of time, but it should be pretty cool when people are actually using stuff like that. So now let's talk about what else we can do.
Why not use, I know there's Project Alchemy to bring ZK Snarks to Ethereum, but why not just build that exchange on Zcash where ZK Snarks are in place and you have those confidential transactions?
Huh. Does Zcash support smart contracts?
I don't
think so.
believe so, but I think Project Alchemy might. I'm not.
So I think you'd have to run a private blockchain and then use Zcash to transact on that private blockchain somehow. Sounds cool.
I don't know what insight you can give us on how like Shapeshift matches up those order books, like touching on the point about fair.
Yeah, so Shapeshift essentially is a peer, right? It's a peer-to-peer transaction. It's the way I understand it. It's basically you tell them, hey, give me a quote. They give you a quote, and then they just match you.
So it's just front loading the decision making.
Yeah, they give you a price, they charge you a fee, and it's a pretty great service, I think.
Are you familiar with EtherDelta?
Yeah.
Can you speak to that, I guess, like what issues that has?
Right, so EtherDelta, I would say, is a blockchain-based order book, and I would say that they probably suffer from a lot of this.
They don't do matching.
They don't do matching on-chain?
No, that's by design. Right, well, no, yeah, it's intentional, but when you talk about an order book and you look at EtherDelta and the lack of liquidity, the reason EtherDelta doesn't have liquidity is because they can't run the matching algorithm on chain. So you would have to run the matching algorithm in your client, and that client doesn't really exist. And so that's why there's no liquidity on EtherDelta.
Yeah, I would say that there's also low liquidity because they charge for, well, by design, they're charging for orders and cancels. And so you can't just have someone.
No, actually, EtherDelta is not running orders on chain. Orders actually are signed, matched, and it's taking the order, charges gas, not actually placing. So the makers aren't charged the fee.
Oh, interesting. So you just get charged on the execution?
Yeah.
Okay. Where do they run the order book? Do you know?
Well, there's a failover that actually falls onto the chain that's just not turned on normally. There's a guy, Zach, who runs in Chicago and has a couple computers running like a side, not off-chain, but it's... Yeah.
So it's a centralized solution, essentially.
Yes and no.
Okay. Parts of it are
They're signed by your accounts.
Yeah.
Your Ethernet accounts, so you can't do anything with it. Every so often, the order book disappears.
All right.
Hi, I'm actually from EtherDelta.
Oh, sweet.
So yeah, there's an order book server that has the off-chain orders, which, as you mentioned, are the off-chain intends to trade. So it basically means that there's no gas price for creating this order. You
Got
send
it.
to this,
Got it. Yeah, I was mistaken. Sorry about that.
And then it goes on-chain to actually do the matching.
So it's similar to 0x?
Yeah, 0x is basically EtherDelta's implementation plus a token.
Got it. How do you guys do the matching algorithm?
So the matching happens at the UI. So basically, you pick which order you want to trade against, and then you tell the blockchain, here's the order I want to trade, and it does the transferring of funds.
Got it. So it sounds like 0x. Similar. Yeah.
This may be a little off topic, but is there like a going hypothesis as to like what the run-up across the board with cryptocurrencies has been over the last month and a half, 2 months? And I'm trying to kind of go through this and come up with some theories, but
I think there's been a lot of news, positive news. And I think that's probably driving a lot of it. I think also, for example, Coinbase lists Ether, a little while ago. I think there's just been a lot of events that have kind of driven liquidity into these. I don't know if I would be able to specifically point to one. Does anyone want to talk about crypto prices?
Yeah, I think there are two things with Ether. One is it appears in this season of Silicon Valley, I think. Korea at a Sony event where Sony made some comments about how Ethereum could be used for, in-game currencies. And apparently there was a huge spike in Ether trading on South Korean exchanges because of that. So I think those were contributing to that.
I think also the Gnosis crowd sale, like,
Yeah.
because it's sold out and it's such a high market cap, I think that spiked the price by like 30%. There's all these positive events happening, and I also think there's not that much liquidity in Ether overall, and so the price can move with less volume than something like Bitcoin. So.
Yeah, so I don't really buy much of this good news stuff because I don't think the news flow is that much different than it's within the last 18 months, the news flow. And we've seen Microsoft, IBM, all that stuff really started like last June when Ether was at like $3. But I think when you think about it in terms of market cap, the whole market cap of Ethereum right now is $7 billion. Bitcoin is $25 billion. These are still like really, really small things. So like, you look at like companies that are like 7 billion, there's just like a whole bunch of those. So I think there's a lot of just like FOMO and like people trying to get in, and like, if you look at like Wall Street and like the bets people place on things, like 7 billion is like the size of a position a hedge fund might have in something, just like one. So you really only need like 4 more big traders to decide like I want to put money in Ethereum, and then the price goes up 50%.
Yeah, and I think Sam Kasser from Consensus had an interesting theory that USD is just getting weaker. You see the tax plan that's been introduced, very aggressive, and crypto goes up by 10% that week. So
many exchanges are priced in Tether, and Tether is definitely getting weaker, right? So even if the global USD may or may not be getting weaker, Tether is definitely getting weaker, which would boost the price.
I think that like one, you can normalize for all that stuff and just take like the Bitstamp price, like the normal price of like Bitcoins and like all these assets is still like at the high regardless of like this other thing. And two, the dollar is still like in like a multi-year way at the highs.
When we're talking about the value of the chain and the cap value, is that the cap value of all Ethereum over what the value is in the market right now?
Yeah, I think it's like
if
the.
it drops 20%, it'll be a 20%. If
Correct.
Well,
I
but
think-
if it were to, it would. Okay, so it's in spot value.
Yeah, you're just marking to the inside bid probably of the entire market, something like that.
This might be a question for you. In a proof of stake scenario, is it possible that a rogue miner would be willing to forego their bond in order to short, or validator, however you call it, but somehow be able to short the market at the same time, so whatever they lose,
Absolutely.
they can actually gain more money on the
Absolutely.
outside?
And you have to sit around, in your isolation tank, figuring out what algorithm you could possibly use to stop those hedges.
But it's possible.
It's absolutely possible. And you have to, like when you're designing a proof, so I designed a proof of stake decentralized exchange system, and with some help of some people who don't want to be named, we sort of figured out like the special sauce for how you stop that from happening. And we don't have any proof that it actually works. It's pretty complicated, and well, it's very easy intuitively, but then to actually create an exchange that works that way would require its own blockchain. You can't be doing other things on the blockchain because these other transactions will actually interfere with your ability to properly rate limit the activity so that you can respond to the externalities of because basically what you're trying to do is you have your internal price, and you need to somehow get information about the global price. Like you have to price the entire activity of your network, and then figure out how that's moving in relation to things like dollars. And then you have to be able to say, okay, we're in a situation where we're under-insuring our transactions, so now what? And I think that for certain systems, like Casper, it's hard because I have to be careful about what I say in public. So in some cases, you can imagine that you're going to have some intrinsic protection, And you can imagine in other cases you would have very explicit protection in your model that where you can provide guarantees to your participants that these events won't happen. So with Casper, you wouldn't get that guarantee. Again, it's not on the Ethereum roadmap to guarantee that your order book's not going to get shorted by some malicious miner or validator. And so that's part of why on-chain solutions have sort of lethal flaws because of exactly what you described.
Just one follow-up on that scenario before when you were talking about, the well-connected miner can influence more in the ordering and how does that happen in the world of proof of stake versus
Right. So so the difference between proof of stake and proof of work is simply the topography issue is still the same. And instead of having mining power, you just have stake. You just bond it to the network. So it's actually easier to hide and move where you are because the miners fundamentally are stuck geographically to be in one place. Whereas if you have a proof of stake system, you can actually move your private keys around, and you can actually appear. You can pop up and down in different places in the network to provide some obfuscation and actually make it harder to detect these sorts of civil attacks. Does everyone here? I said civil attack. I just realized that's domain specific. Does everyone know? Okay, so a civil attack is when you're one person and you pretend to be a bunch of people, so that people can't figure out who you are. And it's from the book Sybil, where they had formed multiple personality disorder. Yeah,
Any other questions, comments, suggestions?
Is this the end? Do you have slides after this?
No.
Oh, so I have a lot of ideas. I love to talk about this stuff. I mean, it's a really interesting problem space simply because I'm a skeptic and I'm not really a big fan of crypto economics, and I don't think that you can really make the sort of guarantees around security that Bitcoin likes to make with regards to price fluctuations outside of the network, right? And so if you start, it's weird because you're listening to these people and they're like, Bitcoin's going to run the world, and we're like, yo, dude, we're not going to run like $20 trillion through this mofo. Like, you're full of it. Like, it's just not going to happen. So, when you really start to think through these architectures, and you're like, well, I'm Barbados, right? I'm Barbados. I want to run the Barbados. It's smaller than Brooklyn, right? Barbados is smaller than Brooklyn. Can you run the Barbados economy through Bitcoin or through Ethereum today? Probably not. Like, almost certainly not. And so, there's a lot of interesting challenges in how do you, a lot of this order book stuff. So my basic view on state channels is like, if you do peer-to-peer matching, that's fine. You want a public order book of some kind, but fundamentally you also need to have some sort of model of a private order book. And a ZK Snark architecture, it depends on how egalitarian you want to be. I mean, we're in New York City, finance capital of the world, whatever, right? So you guys probably all are going to, fly out if you're in private helicopters or whatever. So the cost of generating ZK Snarks for your $1 million orders isn't going to be a big deal. But if you're trying to do something like Shapeshift, where you're processing $5 transactions, the cost of generating a ZK Snark is actually going to be prohibitive, right? You're not going to be able to generate enough ZK Snarks in time to fill all the orders at $5 orders. So you have to have a different privacy model or invest in a company that builds ZK Snark hardware. Just throwing that out there. But yeah, so I think there's a lot of interesting, like I said, I would love to, I mean, it's weird, I'm publishing my stuff at some point in the near future, but I also have to sort of figure out where other people are in the space and not publish too far ahead of where everyone else is.
You want to go?
I just want to get a little deeper into smart contracts, what they are, what they need to be. My understanding is they can be coded for anything, and they have a compliance factor, and they check right?
Sorry,
It's
what was
on a
that?
completing transaction.
Compliance?
That's a good way of thinking about
Right,
it.
it's a code based on a completing transaction that ensures compliance and audit.
If you,
by
if you read it correctly,
I mean, obviously.
No, that's a big if.
That's any contract.
Yeah.
Let's be honest, it's
Yeah.
like, right?
Yeah.
That's just contracts. Badly written contract is the most useless thing in the world, period, in any field. The question is, do they have to stand in every transaction? That's what I was getting. Or are they an additional thing that you can add to an Ethereum?
right, so there's two different transaction types, right? So you can do just smart contracts. I mean, you can do a simple send that doesn't really have much of a smart contract component to it. It's just as dumb, it's like a Bitcoin send, more or less.
It's just like I sent it, you got it.
Yeah, but you can also add a lot of logic. You can add a lot of any turn complete,
If this.
yeah, conditionals, and you can rely on memory inside the state, which is super dangerous, but you can do it. So I describe it as the most developer hostile environment I've ever experienced or heard of. It's like landmines like on fire. It's like I don't know how to explain. I don't know what analogy is sufficient for how dangerous it is to
There's
build.
nothing about the smart contract, sorry to take over, but there's nothing about the smart contract itself that can't be then pulled out and used somewhere else. Like outside of the Ethereum as an exchange
Absolutely.
currency, like it's a concept that can be
Applied anywhere.
applied anywhere. What's the benefit to it in the Ethereum chain? Is it that the compliance auditing segment of it can be done on the chain and therefore there's a benefit?
Wait, can you rephrase? I mean, the benefit was the core Ethereum team got paid $18 million.
I mean,
that's the benefit.
I mean, yeah. So, is there a benefit?
Well, it's hard to overthrow that network as well.
Okay. Say again?
It's hard to overthrow that
So
network.
there's like, it's in some ways harder compliance than just, different things or whatever if you had a smart contract between two people.
I'm not sure if compliance is the right word to be using. It's
Complying with terms of the contract, that's not.
Yeah, but so contracts maybe not the right word in an audience like this. Think of it as an on-chain program, rules for a program. And then when you send, when you don't do a simple send, you're basically executing a function with, and it can error off and not do anything properly.
Think about a stored procedure in a
A
database.
contingent transaction, maybe?
It's a stored procedure in a database.
Stored procedure, and it could be,
And it can be change memory, or it could be,
basically whatever you can program.
Yeah.
Understood.
I think you had a question.
in terms of security for safeguarding Ethereum, like either friends, family, self, I think exchanges are generally considered to be like not the safest place to maintain like your Ethereum or whatnot. But like, does anybody have a recommendations for like tools or wallets or whatnot that are maybe best practices for I guess the future of what's happening here? Yeah, like one of these things.
Yeah, I would say, hardware is probably the.
It's called the crypto steel, and it's you get these little tiles with letters and numbers, and you slide them in, you slide your private key in there. So I mean, if your house starts on fire, like this is still gonna, it's better than a paper wallet. So,
What happens if you lose it?
well, you're screwed. There's nothing on it.
Anything else?
So are these like unsolvable problems, or like problems that will be solved in like 5 years?
I think it's like 2 to 5 years would be my guess. I think state channels will probably get us a lot of the way there.
Do you think we'll reach at least like at parity with centralized exchange solutions in terms of like feature set eventually?
I think so, eventually.
And plus hopefully a little bit of benefit on top in terms of trusting one, I guess?
Exactly.
I don't think they're ever going to be. I mean, it's different markets, right? You're making different trade-offs. In computer science, you're always making time-space computational trade-offs, right? So encryption has a cost. So at a minimum, just signing the transactions means you're going to have a cost associated with that, and you can offset that cost with hardware, with custom acceleration, and what have you. But ultimately, these exchanges are for a different market, and they have different performance characteristics.
I think we'll get close though.
Oh no, I think we'll, for a normal person, it'll be the same difference. But if you are, a hedge fund or whatever, you're going to have a preference over one or the other.
What about the market maker aspect? That part kind of interests me too, like, in terms of like, no one's gonna want, because it costs money to put up an order, it seems like huge friction. Like, do you have any idea how that can be solved, like, what direction?
Yeah, so I mean, the state channel solution is to do everything, all the orders and transactions off chain, and then you communicate them back to the chain later. So theoretically, under that solution, you wouldn't have to pay for orders.
For that, for state channels, do you, is it between like just two specific parties, or is it something that like is, how do you visualize that?
I think like what Rick was saying is that it's optimal for 2 parties, but you can have any parties join the state channel,
Yeah, the
theoretically.
state channels are architected right now in the Ethereum community, they're bilateral, but that's not really necessary. So when people in Ethereum talk about state channel, they're talking about bilateral agreements. But you don't have to architect it that way. I mean, years ago, I did other stuff that wasn't, it's crazy to say that years ago. That wasn't bilateral, it's just not popular for an assortment of reasons.
Gotcha, so is there almost gonna be like I'm not exactly sure how it works, but you enter into the state channel, and then you're able to transact with the members of that channel?
Yep, everybody puts a bond onto the public chain, and then they P2P connect with each other off chain, do their thing, sign their messages, send them back and forth. Then at some predetermined time, predetermined based on events or what have you, they publish the results of what happened in private to the public chain. Money is redistributed as necessary. So if you made no trades, you get all your money back. If you less some transaction fees, if you made some trades, they're netted out in public.
So do you see each of these, like, each market as being like its own like giant state channel group, or like, oh, I want to trade Ether for rep or whatever?
Probably
That's
each
an
pair,
architect-
yeah.
I think that's a model that people will use. I think we're going to see, because there's so many groups operating in private, building these decentralized exchanges and non-custodial exchanges, which weren't really discussed in the talk, but because we're seeing so many of those different models, if you can imagine it, like there's some 24-year-old kid somewhere making that thing. So yeah, there's definitely going to be like, oh, we're just doing this pair in this state channel over here. We may or may not announce it. If you're clever, you'll be able to detect that we're doing it on the blockchain from our bonding and the unbonding of the state channels. But that's the only way you'd be able to know. And I think there'll be a lot of that, but that to me isn't the same thing as an exchange, right? I mean, sort of like the comparison between OTC and exchanges, right? That's very much more of an OTC situation, and it serves a different purpose for a different market.
Talking about coming back to like latency and all that stuff where it comes to whatever a market is, on that latency characteristic, is there going to be kind of a Malthusian issue, like an issue of hitting an asymptote where the blockchain will proliferate to take up the space of the processing power to run through the blockchain? Like, is there going to be?
We have at minimum, you have a latency between the nodes,
Yeah.
I would say, plus whatever it takes to mine the transaction.
But I mean, this is just a rough conceptual question. Is there a proliferation of nodes and connections to fill up the space of the processing power?
What do you mean by the space of the processing power?
Like the amount of time to check it, right? Like.
Oh, you mean do you run out of time? Like if you have a 15-second block and you have too many transactions in the mempool to
Not exactly.
to process in 15 seconds?
That is not exactly what I was thinking, but that's actually interesting to me. But like, basically, one, is there a timeout, I guess, now? And then two, is there an issue where, I mean, from my understanding, latency goes up over time as the
Network gets bigger.
As the network gets bigger, period.
Correct.
Right?
Yeah.
And we're talking about whether it's the application of brute force processing power over time to get there. Is it like, that's why.
Yeah. Okay. So now that's a
like,
basic proof of work difficulty question that you just asked. So to put that in proof of work context, the proof of work will adjust for whatever the target time is. The target time on Ethereum is 15 seconds. And they're under that time consistently, which is actually kind of worrisome to me, but that's a different detail. Yeah, as the network gets bigger, they're going to have to balance that out, except we're not going to have to balance it out, so we're going to move to proof of stake. And at which case, that whole set of questions kind of changes. But yeah, there are definitely there's a lot of algorithms, there's a lot of thinking about these sort of racy, non-deterministic, how are you manipulating data in the mempool, what happens between the validators, what happens if you have leader election, how are you doing leader election? We haven't decided how leader election works in Casper yet. Are you familiar with like fault tolerant network leader election type problems? Okay, so there's a class of space, classic literature. Too much to talk about here. Fault tolerant leader election. So if you look at Raft is probably the easiest, most understandable example of that. And it's important in Casper or any blockchain technology to have non-deterministic leader election. And even non-deterministic is the wrong word because they have to determine it. And Dfinity is also a good example of that. So Dfinity is Dominic Williams' blockchain. He's using threshold signatures to do leader election, which is like pretty awesome. And I think we'll probably all end up doing that at some point because it's basically the best solution. But yeah, your question, to answer your question about precisely in proof of stake requires a lot of knowledge about leader election that we don't really have.
Okay. Sorry.
Is there anyone here from Gnosis? Maybe I think they just raised capital for this, and they will probably incur the same problem. So do they have any vision on how to solve these issues?
I don't think anyone's here, but yeah, I think they'll invest in this pretty heavily. Yeah.
I would just say about leader election, the way I think of it is like, ultimately, if someone decides like the order of the transactions in a block, and you probably don't want the same dude deciding every single block, all the how they're gonna order all the transactions. So like most systems, most consensus methods will have that change. In proof of work, it's like the random miner finds it, so it's kind of like hard to predict who's gonna find it, because it's all random. So like, how does your proof of stake network like figure out like, you made this block, like you're on deck to make the next one, you're on deck to make the next one, and like how do you make it so that way like no one can game that system where I know that I'm the third block, so I'm gonna like hack that one.
Okay. I get the concept.
Any other applications where this sort of like front running problem becomes an issue?
Which problem?
Like the front running issue, which I think is kind of related to what you guys are talking about in terms of like who decides how the transactions are ordered.
Yeah, front running is a huge issue on a blockchain, right? Any mechanism that you have where a miner has an ability to make a transaction in response to your transaction, and a miner has the opportunity to front run. I mean, in ways that you wouldn't even think of in normal life, they don't happen. But when you try to take that application and apply it to the blockchain, the miners have this privileged information, and they have the opportunity to manipulate the transaction order to your disadvantage. So yeah, it's a huge problem generally in the blockchain space.
Just to like piggyback on that, so like the whole problem is like in a block, all the transactions are kind of like equal. So like you make your transaction before I make my transaction. If a miner just picks which one comes first, like he's in charge of like deciding that. It's not like yours like occurred first and mine occurred first. Like ultimately they end up on a blockchain and they're like ordered. So like the only finality is like whether it's in that block, but like the ordering of what's inside that block is controlled by the miners. And like that's the tricky thing compared to like, you using your credit card now versus in like 2 minutes. If the block is only produced once every 10 minutes, then like the two are like indifferent, and it's just the miner deciding which one you want to put first.
What about injecting a transaction of their own? Is that?
Of course they can do that. Yeah, of course.
But not censoring transactions.
Right. Correct.
Okay.
Hmm?
I mean, they could.
They could censor. I mean, here's one of these funny things about blockchains, right? You're like, okay, so if this was like a real money game, like if people really had skin in the game, then you'd see a lot of stuff that you don't see. And one of those things is censoring transactions. We don't see anywhere near the amount of transaction censorship that you would expect if it's weird. There should be more censoring than we see.
Is that a harder attack to do though than injecting your own transaction?
It's a question. I mean, it's application dependent, right? So and this is why you don't see so much of it, because Bitcoin is a single application blockchain.
Yeah.
But when you look at something like Ethereum, where it's going to be multiple applications, and the applications are actually interacting with each other, which people sometimes discount, you'll see more of these transaction manipulation attacks as more value starts to actually enter the network.
And I think another one, depending on the kind of contract you're interacting with, would be not just miners seeing your transaction, but other people that have access to the mempool simply paying a higher gas fee to be added to the block earlier to effectively take your transaction before you get it.
Exactly, and the miners don't care about that, right? The algorithm is explicit. I mean, this is one of the problems with using a public blockchain is because it's a public blockchain, explicitly it's very difficult for your smart contractor DAP to see that malicious behavior and do something about it.
It wouldn't even see it because it's not, to the
Right.
contrary, it's not malicious, it's simply the only transaction it's seeing.
Right, exactly. So it's very difficult to protect against that class of attack by just, and it's not really an attack, right? I'm a user, I'm reading the mempool, you're a user, you're reading the mempool. I do stuff to manipulate the mempool, it's to your disadvantage. Welcome to blockchains.
Should we wrap up? Sounds like it. We're working on a solution as well, and we have a white paper that we're sending out for review. And if you're interested in that, please send me an email.
Your role, the consensus, that's what I say, what are your ideas for your solution?
We're not talking about it publicly yet, but just shoot me a note, and I'll just tell me a little bit about yourself. We're going to probably pick like 20 people to review the white paper with us.